Okay, so good evening and welcome to the stream today for our advanced taxation examination tomorrow morning. And we want to, as always, go through a couple of things and then also if there is anything you want to ask me about or you want me to share my thought on, then you can also hit me with that. So before I get excited, is there any questions for me? Something specific that you would want some clarity on or something like that? Whatever. Any questions for me before I go? Those of you joining on Zoom, you can raise your hand and bring you up or you put it in the chat for me. Any questions for me? And I say I should go through whatever the heck I want to do, or let's go and sleep and close if you don't have anything. Okay. Yes, Ebenezer.
All right. Nhyira, good evening.
Good evening.
Yeah, I want you to try to explain what an exempt person is. I've been reading it, but I want what an exempt person is
In
in taxation.
an exempt person is simply referred to as a person who is exempted from the payment of taxes, generally in that particular case, in that context. But
Hmm.
I don't know if you are reading it also in the context of thin capitalization.
Yeah, in the context of thing capitalization.
Yeah. So in the context of thin capitalization, that definition there that says, oh, when there is an exempt person, then the equity of the entity has to be, the debt allowable for tax purposes should not exceed what? What's the rule? Three times, right? The equity of the entity. So the context in there, so as I said, the default thing is that yes, an exempt person will be regarded as any person who is exempted from the payment of tax at the end of the day. But in the context of thin capitalization, that rule simply means that we are looking at two things. So number one, okay, maybe let me just bring up my slide so I can
Yes, 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 please.
Sound. Sorry, YouTube. Sorry, YouTube. Sorry. Apparently, I had muted the output of the stream that is going on YouTube. So, YouTube, can you hear the sound now? Please let me know if you can pick my sound now. Sorry about that. YouTube, let me hear in the chat, or let me know in the chat if the sound is okay. Sorry, I think I muted the sound. Yes, Candy, what you got? Now, Candy, hold your question. I want to say something here. Then I come to you. Don't forget your question. Okay. So the last thing I want to say, since I'm on the thin capitalization here, I want to say here is that the thin capitalization rule comes in under two circumstances. Number one, where the entity is borrowing money from a non-resident entity, right? In that case, the thin capitalization rule will come in. Number two, where the entity is borrowing money from a resident entity that has a controlling interest in the entity going for the money, then the thin capitalization rule also comes in. So these are the two circumstances under which the thin capitalization rule comes up. Now, a number of things I want to quickly highlight on this as we go. Number one, we look at the debt outstanding at the beginning of the year of assessment under review. Okay, so the debt outstanding, right, at the beginning of the year. Okay, at the start of the year. Not the whole debt that the entity has gone for. You know, there is a trap like that where they say, oh, the entity has borrowed X amount of money. At the beginning of the year, this is how much was outstanding. At the end of the year, this is how much is outstanding. We don't care about how much they went for. We don't care about how much is outstanding at the end of the year. We are interested in how much is outstanding at the beginning of the year of assessment under review. So that is the first thing you must understand there in that particular case. Then the second thing is that you need to make sure that where equity is negative, then all the interest on the loan notes and any foreign exchange loss will be disallowed for tax purposes, meaning we're going to be adding it back to in determining the chargeable income of the entity. Okay, so when equity is negative, it means you don't qualify to go borrow money, and hence if you borrow money from a non-resident entity or a resident entity that has a controlling interest in you, the rule is not going to be applicable in that particular case. And so that is what the second thing you must understand. So how do you get negative equity? Probably in the question you will see that, oh, the share capital is 10,000, but the retained earnings or the income surplus is negative 40,000. That means your equity, which is share capital plus retained earnings, is negative 30,000. Negative 30,000. That means you don't qualify to borrow anything. So all the interest paid during the year will be disallowed for tax purposes. Any foreign exchange losses arising from the capital repayment also be disallowed for tax purposes. Sounds good? So that's the second key principle that you got to be mindful of. Principle number 3 on the generic side of things is that at the end of the day, you have to charge withholding tax at 8% on the interest for the year. Okay, on the interest payable for the year. Now, the reason why this is important is because sometimes you may allow the debt. You may do the calculation and the debt allowable for tax purposes is going to be, yes, 3 times the equity generally, but that the outstanding debt exceeds that. And so you will not write off or allow all of the interest expenses. So only a portion of the interest expenses may be allowable for tax purposes while the remaining amount is disallowed. We don't calculate the 8% withholding tax on the amount we have disallowed or the amount we have allowed. The withholding tax is calculated on the total interest payable to whoever is going to receive the money at the end of the day. And so that is the idea generically when it comes to dealing with the concept of thin capitalization. When does it apply? And how do we dance our way out in that case? Which means if you look at the debt outstanding at the beginning of the year and it is more than 3 times the equity, positive, then all the interest and foreign exchange issue will be allowable for tax purposes. So that is the idea about the thin capitalization concept and where it is applicable. Right? So, Candy, you can come now. What the heck? You have?
Good evening.
Yeah, good evening.
I have multiple questions, but 2 relate to this one. So,
okay.
For the thin capitalization, so I want to clarify, we do not carry over losses here, right?
No, there is nothing like losses carry forward. If the interest is disallowed, it's disallowed. You don't carry it forward because interest is paid every year. So the interest, if it is disallowed, you can't carry it forward. It's you lose it. In that case, it is financial cost that the amount that will be disallowed can be carried over for 5 years to write off against future chargeable income or gain.
Okay. And then, Nhyira, let's say, I don't know if it is a question, but I want to clarify. Let's say in a given question, the equity is negative. That means we can't apply the thin capitalization here. What if the question also accesses the tax implication of borrowing from a resident entity? Do we also say that because the equity is negative? So
a resident entity that has a controlling interest in them?
No, a normal resident entity.
No, that one thing, capitalization doesn't come into town at all. So the interest will be deductible for tax purposes.
Okay, right? So we don't apply the negative equity there.
We don't. Thin capitalization doesn't even come to town at all there. So you wouldn't think about, oh, do I have equity or not? Because they are borrowing the money. So like for instance, a company in Ghana goes borrow money from EcoBank. Yeah, the interest on the loan from EcoBank, if EcoBank has no interest in that company, will all be allowable for tax purposes. And so we wouldn't even bring in thin capitalization. So that's why I said there are only 2 circumstances where thin capitalization is coming to town. One, when we are borrowing money from a resident entity that has a controlling interest in the entity, or 2, when we are borrowing the money from a non-resident entity or investor. So those are the 2 circumstances under which we could call on thin capitalization.
Okay, thank you. Then, Nhyira, my other questions. One is, what is the tax implication on research and development?
Tax implication of what?
Research and development.
Okay, it depends on where we are standing at generally. So we have to look at it from the perspective of traditional firms, as you know already in our workflow, and then the non-traditional, which is the mining and oil exploration guys, right? So if we're in the mining and oil exploration guys, certainly research and development means they are doing some exploration or reconnaissance or something like that for a new site. And so as you know already, it will be disallowed for tax purposes, and that will be capitalized because it will be put in a separate pool in relation to that separate thing that they are doing the research on. So it's going to be disallowed for tax purposes in that particular case. Now, when it comes to the traditional firms, usually the research expenses is going to be written off in, it's going to be allowable for tax purposes for the most part. It goes with the IAS 38 concept, right? That research expenses that we are incurring in the normal course of activity, it will be allowable for tax. It will be written off in accordance with IAS 38. The same rule is going to be applicable here in that particular case. So if it is research expenses, boom, we're going to be writing it off. But capital expenditure incurred on research, then those assets will be will be the cost of that will be disallowed, and those assets will be put in the pool so that capital allowance will be granted. Sounds good. So if it was a computer they bought doing the research, then that will come in pool 1. We add it to the written down value brought forward, and then we'll calculate the capital allowance 40%, reducing balance basis, boom, boom, boom. Then we go away. Now, development cost, on the other hand, goes with the same rule as per, again, what is happening in IAS 37. If the entity is going to, there is that criteria that they are meeting, that there is a separate project, the cost can be estimated reliably, and it meets that IAS 37 criteria and the entity has capitalized it, then certainly the tax authority will also treat that as an intangible asset, which is pool 5, right? So that it will be, capital allowance will be granted, which means it will be disallowed for tax purposes, and instead capital allowance will be granted as an intangible asset over a 10-year period, or at 10% straight line method in that particular case. But where the entity, or there is no proof of concept that this thing will go anywhere, then it will be written off, and the tax authority will also allow it to be a deductible allowance. So we are just moving with the same idea in IAS 38 on how we're going to be crystallizing this in taxation. Does that make sense?
Okay. Nhyira, thank you. Should I continue my questions?
It's like, why, you have a list? Okay. You bring one more, then we'll see if somebody else has, then, so that it doesn't become monotonous. So what do we do? What else?
Nhyira,
What's your next?
Tax expenditures of government?
Hey, ready, yes, Christo. Sister, yeah, questions being a chess. I'll best take questions be a mommy. Yeah,
No, they are from your own questions. I just wanted to.
All right, so the tax expenditures on God, which questions are that? So that maybe I can just drop you the thing. When we say tax expenditure of government, it simply means the losses that governments have to, the loss in revenue for government as a result of the relief or incentives given to taxpayers. So tax relief is a tax expenditure to the government, because when the government gives tax relief, it means those companies will not pay their taxes. So government has lost revenue, so it becomes a tax expenditure to the government. Tax holidays. Come on, you got to pay taxes, but here you are, government says for the next 10 years, thou shalt not pay taxes. That becomes a tax expenditure to government, because government is losing that revenue. Personal relief for individuals, marriage, child education, what else? Disability, aged dependent, old age. All those are tax expenditure on the government. Why? Because these are reliefs given to individuals, which reduces how much their chargeable income will be, which will be also be based on, which also reduces how much tax government can collect. So all of those nuances, all of those incentives that result into providing relief and reducing the tax liability of the taxpayer becomes tax expenditure for the government. Do you get the idea? So you think tax holiday, you think about tax relief, you think about tax, rebate, reduction in rates. Okay, you think about personal relief to the individual. All of those things are regarded as the tax expenditure to the government. So anything that, another thing is the foreign, did I say foreign? Sorry. Fresh graduate relief. That's also an expenditure to the government, because now that fresh graduate relief is going to reduce the chargeable income of the company. So government is going to lose it. So think about it as the various benefits relief available in the tax law, which taxpayers can leverage to reduce their tax liabilities. That, on the perspective of the government, becomes a cost to the government because government is losing those revenues. Does that make sense?
Sure, thank you. If I
Okay.
have more, but since Isa should stop, I'll come back later.
Okay. So any other questions? Any other questions so that if not, then I could keep going with Candy because it's like Candy and Ebenezer are on the swag that we have to still be talking about anyway. So, okay, so Candy, maybe you can come with maybe 2 or 3 more, then we go.
Thank you. Ishua,
Mm-hmm.
when they ask us a question like this, when is interest treated as a deductible allowance? How do we go about it? Is it just, do you include both the resident and then the non-resident explanation?
I don't get it. Like when is it resident and
The
non-resident
question
plan?
was, when is interest treated as a deductible allowance?
Okay. Okay. Okay.
So if I want to explain, do I use the residents, like we allow all of them, and then they think capitalization based on this 1, 2, 3, 4, 5 reasons, or where do I go from?
Yeah, so the two can be applicable based on where you are coming from generally. But when it's interest deductible for tax purposes, when the loan, okay, when the entity has gone for a loan, okay, so the entity must have gone for a loan, number one, and the loan is used in the generation of income. Okay, so they've gone for a loan, then they are paying interest on the loan, number two. Then number three, the loan is used in the generation of income for the entity. Are you getting it? Because if you go for a loan from the bank in the name of the company, but use the money and give it to the MD of the company, the interest on that loan cannot be deductible for tax purposes. Why? Because that loan is not used in the generation of the income against which you want to claim the deduction. So we have gone for a loan. We are incurring interest on the loan. Number three, the money is used in generation or generating the income of the entity. If that is the case, then the interest will be allowable for tax purposes. So that's the generic answer to that question. Very sweet, simple, straight to the point. We've gone for a loan. We are incurring an interest. The loan is used in generating the income of the entity. Then the interest may be deductible for tax purposes. Now, if you want to get goosebumps, then you can bring in those thing capitalization ideas. But it depends
I'll
on
look
the
at the
marks
notes.
allocated there. So if you don't want any goosebumps, which will screw you up, you just stay within the ambit of this presentation, and that is okay in that particular case. Sounds good?
Okay. Yes, sir.
Okay.
Then Isha, let me add this so that you go to the next one. I'll be coming back later.
Mm-hmm.
Isha, on dividend, when does the when will the Commissioner General declare dividend for a company?
Okay. So on dividend, since you've brought it up, let me, expand the discussion on dividend, and then we look at it. Now, if you remember, we said that by default, okay, for companies, dividend payment will be based on percentage of ownership. So if we own less than 25% of the company, please be careful here. We are not looking at it from the perspective of the entity paying the dividend. You are looking at it from the perspective of the investor. So if the investor holds less than 25% of the equity shares in the company paying the dividend, then that dividend that the company is paying will be subject to a withholding tax of 8%. However, where the investor holds more than 25%, okay, of the equity shares, then the dividend is what? tax exempt. So that is our default principle on dividend. Please, not from the perspective of the entity paying the dividend, but you have to look at it from the perspective of the investor entity. Very important. And you know, dividend payment is not an allowable expenditure. You know that already. It's not an allowable expenditure because you don't pay dividend and bring it in the P&L. Dividend payment is dealt with in statement of changes in equity. So it's not an allowable expenditure. But that is the default thing. The third thing is that when we deal with mining and petroleum companies, here, irrespective of the ownership, dividend payment is subject to withholding tax of what? 8%. Okay? So withholding tax of 8%, irrespective of the percentage of ownership. All right? Then, number 4, free zone enterprises. I can't even spell zone. Free zone enterprises. What did we say? Free zone, dividend is free money. Okay? So dividend is tax exempt. You remember that, right? The dividend is tax exempt. And so these are the issues here when the entity declares dividend. Now, there are 2 other special situations that may result into the Commissioner General demanding that you pay dividend withholding tax. The first is where the entity makes transfer from the retained earnings to share capital. Sounds good? So when the entity, and that is the entity is making a bonus issue. So when the entity makes a bonus issue, that means they are transferring money from retained earnings into share capital. Now, that is deemed as dividend. So Commissioner General is going to be seeing that as dividend. And because the Commissioner General sees that as dividend, that amount that has been transferred, the amount of the bonus issue from the retained earnings into the share capital, will be subject to a withholding tax at a rate of what? 8%. But remember that there are 2 tax implications on this particular transfer here, because we will also pay a stamp duty, okay, on the amount that has been transferred of 0.5%. Again, it is not 5%, it is 0.5%. So when you are punching that, it becomes 0.005. So be careful. It's not 5%, it's 0.5%. So that is the second, or that is the first of the other scenarios where dividend has to come to town. When the entity makes a bonus issue, which means they make a transfer from the retained earnings to the share capital account, then it will be deemed as dividend, and as such, dividend withholding tax of 8% must be paid. And then the stamp duty of 8% will also be collected, because there is now increase in the share capital. And when there is increase in share capital, the stamp duty is 0.5%. Now remember, this is for the exam. In reality or in practice, the rates of stamp duty varies, but for the purpose of our exam, we're just going to be staying with 0.5%. So that's the first of the other scenarios where dividend will come up. The second one is where, how do we call it? Candy, your question comes in. That says that when we have a private company, okay, so there's a private company with ownership, I think less than 4. With ownership less than 4 people, okay, and they have not declared dividends. Hey, what kind of business are you people running? But Commissioner General has been informed that, hey, the owners of this company, they are buying cars, they are chilling. Where are you people getting the money from? You've never paid yourself any dividend. In that case, Commissioner General will take beef. And so, under that circumstance, Commissioner General will say, hey, Munja in same, no. Literally, right? And say, hey. He can declare a number of years' profit as dividend. So that's the issue there. So this is Candy, your specific question. So a private company with ownership less than 4 people and they've not paid dividend for a long period of time. In that case, GRA may step in and say, hey, listen, you guys, come on, man. What the heck? What are you guys trying to do here? Declare dividend, let me get some money. So that's another scenario where there will be dividend withholding tax coming in that particular case. Then there is this other concept. It doesn't relate to dividend, but let me talk about it because probably it won't come anywhere. It's not about dividend. It's about general taxation, but let me talk about it. Companies can carry over losses for 5 years, but there is an exception to that rule. If there is a company that has been operating, just almost there, almost carry over losses now, then they are still in operation, GRA can step in and say, hey, and declare part of their revenue as chargeable income and demand that the entity pays tax on the 25% tax on the revenue. So that's not about dividend, but I said, as I'm explaining, this came in, so I want to throw light on that for you. So yes, an entity can carry over losses for 5 years, but if you are making the losses, and you are still in business, Charlie, who makes loss and still stays in business for a long time? So that means there is something you are doing. Either you are cooking the financial statement and lying to GRA that you are making losses and you don't want to pay tax. And so under that circumstance, the Commissioner General can step in and say, hey, bro, let's do something. How much revenue did you earn this year? You have been operating for the last 8 years. You've been making losses. But look at your revenue figure. How? Well, how do you run the company? So that means GRA is not getting anything. And remember, we need money to run the country. So GRA can step in and say, hey, listen, a certain amount of revenue for that year, maybe that year's revenue should be declared as chargeable income, and then they pay tax on it. So that is the exception to the rule of carryover of losses. The reason why that clause is also there is to prevent people from abusing it. Like I was saying, if I know I can carry over losses over 5 years, what do I do? And I say, I'll just be cooking. And every time I'm going to be recording losses, GRA will come, oh, loss. GRA will come, oh, loss. But you've been recording revenue. How the heck? What kind of business are you running? And you're still in the business. And so under those circumstances, GRA could declare some of the revenue as chargeable income, and a tax will be paid on it. And you have to pay the tax. All right. Now, remember, this then leads me to another thing. But before I go, Candy, are you okay with your question? And then the expansion of these concepts to everybody else. Is it clear? Or there is any follow-up in these dividend environment? Yep.
It's clear, but I want to ask a question before you move on. The carryover losses is to the benefit of the firm, right? Because if I make losses, I can carry it over. And if you are carrying it over, you'll be deducting from your So then why then would DRA come after me? Because it's like after 5 years, if I'm not able to pay how do they say it? Like after 5 years,
But
then
this is how it occurs. Let's say you make losses in year 1. That year 1 losses can carry over for 5 years. So year 2, you can write it off against year 2. Now year 2, so what make it loss? That means year 2 loss, no, so you can carry it over for 5 years. That means the year 1, aka 4 years. You go to year 3, what make it loss, biom? That means the loss for year 3 can be carried over for 5 years. The loss for year 2, aka 4. The loss for year 1, ACCA 2. Oh, sorry, ACCA 3. So that's how it occurs. Until you realize that each of the year loss gives you that 5 years thing. So more or less like if you're on this loss spree, it's into perpetuity. Just a whole digger now, bro. Do you get a concept here? That's what is happening. That's why GRA will step in if Charlie, me neighbor. Do you understand? Does that make sense? Have I convinced you to be on the side of the GRA in that particular case? Or Candy, you still don't agree with GRA?
Oh, sure. It's okay.
So that is the idea about that. Okay. Now, so in the explanation of that concept where GRA can step in and declare an income as chargeable income and then a revenue as chargeable income and, declare tax on it, that leads me to, tax administration. One key thing there that we must understand, which has to do with tax assessment, right? So, that we have provisional assessment and then the self-assessment, right? So provisional assessment and then self-assessment, right? Now, the self-assessment is where the taxpayer makes the assessments themselves. Provisional assessment is where the GRA prepares the assessment and sends a tax notice to the taxpayer. Remember the element of a tax notice, the TIN, not TIN number. Don't go and write TIN number because TIN no number dada. That's tax identification number. So the tax notice will have the name of the taxpayer, the tax identification number of the taxpayer, the chargeable income, the taxes payable, when they are supposed to be paid, generally in that particular case. Those are some of the things that will be in the tax notice, and the GRA will send that. Now, when GRA makes an assessment, so for instance, this example that I was talking about, that you can carry over losses for 5 years, but GRA has seen that you people are abusing this rule. Because of that, you've never recorded any profit. Then GRA steps in and say, hey, I've declared X amount of your revenue as chargeable income, come and pay this tax. In that case, you have a right to raise an objection against it. But if you remember, we spoke about the procedures you must follow and the condition that must be satisfied before GRA will entertain any objection. You remember those conditions? Number one, there shouldn't be any outstanding taxes. He who comes with equity or he who comes for equity must come with a clean hands. Until Wabane say you have come that we have assessed you, you are supposed to pay a tax. Make sure you are not owing us any tax. That's the number one. Number two, if the tax assessment in question relates to the domestic income tax division of the GRA, which means on your income tax issues, then you have to make a deposit of at least 30% of the tax liability before raising the objection. However, if the tax in question, the tax assessment in question relates to the customs division, meaning it's about importation of things, you don't have any right. You pay all the money before objections can be entertained. So those are the conditions that must be satisfied before you can raise an objection or the GRA can raise an objection. So number one, there shouldn't be any tax liability outstanding. Number two, if the assessment in question relates to the domestic tax division of the GRA, at least 30% deposit must be made. And then number three, if it relates to the customs division of the Ghana Revenue Authority, then all payments must be made and SANA GRA will entertain you. So if the entity meets that condition, then it can write formally to the GRA detailing out what the heck is happening, attaching the tax assessment that the GRA has brought, and then GRA will receive it. I think they have between 14 to 21 days or so to reply to the taxpayer to be able to then determine what has to be done. An audience will be given. You come and justify your case, boom, 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 and then we move from there in that particular case. That is a question you can get for between 7 to 10 marks in the exam hall, where you'll be told that maybe you are the tax intern of the company or you are the whatever the heck, the tax partner of the company or the one in charge of tax in the company, and the CEO comes to you and say, GRA has brought some assessment to them, but they don't understand the assessment, and they want to question the GRA. They want to raise an objection against this thing. Guide me, tax expert. Guide me, tax consultant. So that is the kind of question where you're going to be answering it the way I've explained. That, brah, CEO, say CEO. Now remember the pro forma, right? So if you are supposed to make the explanation to the CEO, then it's going to be in the form of a memo. Remember, communication is key in advanced taxation, right? And so in the form of a memo. So we're going to have the CEO from the tax, whatever the heck you are, subject matter issue, the date. Can be the day on which you are writing the exam, or any date after the date in the question, if there is any. Then you have your introduction coming up. This is a brief explanation of the above subject matter to help you in your decision. Then you talk about the tax issue, the conditions, then you contextualize, then you go away in that particular case. So that is how a question like that could be asked, and it is about tax assessment, really, which is a tax administration question between 7 to 10 marks that the examiner can throw at you, and that's how you answer such questions. Sounds good? That's the idea there. Now, remember, on the flip side of the tax assessment situation I just spoke about, under the self-assessment, it is where the taxpayer is making their own assessment, right, to the GRA. Now, the taxpayer has a right to revise the assessment before the year end. However, where at the end of the year, the taxpayer submits a tax return where the actual tax payable is less than 90% of the tax payable on the assessment, the self-assessment made, then you will pay a penalty because you lied to GRA. So the estimate or the threshold is 90%. So if you said, hey, GRA, I'm going to make an income of whatever the heck, let's say a milli. Okay? So if I'm making a milli, 25% of a milli, that means I'm going to pay a tax of what? 250,000. Right? 250,000. Then I submit an actual returns at the end of the year, which is 2 milli. Which means now I'm supposed to pay tax of 500,000. Bro, if we take 90% of the milli and we look at what is happening, you just lied to the GRA. So the excess will be subject to tax penalty at the rate of 125% of the prevailing rate of the Bank of Ghana. So if the current borrowing rate, what is the current borrowing rate, Crapo? They say treasury bill rate is now what, 19% or whatever the heck. Those of you who deal with treasury bill. Is it 19% or 20%, whatever the heck? So it means, for instance, it'll be 20%. Okay, thank you. So it means that it will be 125% of 20%. And that becomes the rate at which that penalty will be charged. So be mindful of that, because the threshold is 90%. Once you are above 90%, no problemo. But if you are below 90%, bro, you just lied to the GRA. And the reason why you are fined is because the money should have come quickly so that we will use it to run the country. I'm hearing that GRA says this year they are targeting 200 billion tax. Hey, Charlie, these people, they are 200 billion Ghana cedis. We move. So if the money doesn't come early, we have to fine you. And that is the idea there. So that's also something you must understand, which links to the discussion that I was making. So this private company, maybe you may be working for them, or they may approach you that, GRA has come and declared some amount of our year's, profit as dividend, but we've never paid dividend and GRA, Can you educate me on that? We want to raise an objection. Bro, you want to raise an objection? Number one, make sure you don't owe the GRA any tax outstanding. Number 2, since this one relates to the domestic income tax division of the GRA, deposit 15% and sana, you begin the reason with GRA. Then number 3, you can then start the process by writing to the GRA, attach the assessment, give reasons why you disagree with the GRA, audience will be given, boom. You see how beautiful tax is?
So in effect, GRA is into extortion.
Oh, don't put
They
it that
collect
way. Don't say it like that
They
now.
collect money before they listen to you. Okay.
Don't put it like that. That's not fair on GRA. It's not like that because the GRA believes that they know you better than you know you. You know, it's funny, right? And that's how the tax authority behave around the world. Every country, the tax authority feels they know you better than you know you. The reason is because you will not come and say the truth. That, oh, I've earned this income. GRA, come and take your money, Debbie. So they think they know you better than you. So that's why they can come and declare that this is how much tax you are supposed to pay. So that if you are coming to talk against it, what if 30% brand if it is about customs, then you have to cough the whole amount, even before we talk. So it's just an administrative way to make sure. And if the argument is raised and later on they found out that, oh, it wasn't true, the money will return to you. I don't know if you heard about that news last year or last 2 years about MTN Ghana, where GRA said MTN Ghana was owing some amount of money because GRA was using a different method in the calculation of the revenue of MTN, other than the method that MTN uses to calculate its revenue. So because of that method, GRA got a higher amount of chargeable income for MTN and hence declared that MTN was owing X amount of money. And you know MTN, they have the best. They will get a best tax expert to come in and say, hey, GRA, sorry, whoever did this assessment, you toasted. You used the wrong formula. This was the formula we use per the industry best practice. This is the formula everybody is using. Why the heck did you use this formula? And boom. I think that case was settled. And MTN went away because they hadn't done anything wrong at the end of the day in that case. So that is the issue there. Okay, that's the issue there. So that's the concept about dividend and all of the rules surrounding dividend, right? Let's talk about the other income. What else do we have? Interest. What did we say? Interest paid by resident companies to individuals is tax exempted, right? So that's the first rule we need to understand. So, what the heck? 1, interest to individuals, okay, is tax exempted. That's the first rule. Second, the interest paid to companies is subject to what? A withholding tax on account. To entities or companies is subject to withholding tax on account. So what does that mean? It means in our workflow, remember the schedule, because this is very important to me. In our workflow, whatever the entity has done in terms of the interest, we'll adjust for it, subtract it from the top of the workings, so that when we get the adjusted chargeable income from the business, then we bring other income. So under that other income, we now bring the gross interest. Okay, that's why we say it's on account. You know the difference between withholding tax on account and final withholding tax. Final withholding tax means the money will no longer be subject to tax. But withholding tax on account means the money will still be subject to tax. Only that the tax that has been withheld prior by the payee entity will be given as a relief. And so interest to companies subject to a withholding tax on account, usually we go with 8% if there is no rate in the question. And so the gross amount comes down. We calculate the tax payable 25%, bum, 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 and then we will less the tax that has been withheld as a tax relief so that we'll get a tax payable by the entity in that particular case. So that is interest to companies. Then there is this concept, that will be applicable. Interest paid by non-financial institutions. Okay? Interest payments by non-financial institutions. That one is subject to 1% withholding tax. There is a little issue on this thing, just a little, but we're going to be taking this because I've been trying to get this done, clarity on this, but I've not gotten it. So you're going to be staying with a 1% like that. It's subject to a 1% withholding tax, generally in that particular case. So when it comes to the interest income also, that's what we must understand. In the hands of individual, we exempt it. In the hands of the companies, withholding tax on account. Then by non-financial institution, 1% in that regard. So that is the idea about interest as well, right? Then we come to the last thing, which is rent income. Rent income is subject to final withholding tax, so it doesn't even come in our workflow. However, if the company in question is a real estate company, which means the rent income is their revenue, because the treatment of rent income depends on how the entity is seeing that income coming in. It could be revenue to the entity, okay? Or it could be, what's the second thing? Investment income. Meaning that the entity is leasing or renting out surplus assets. Okay? It's leasing out surplus assets. In that case, that is where we say that it is subject to what? A final withholding tax. You know the rate. Residential 8%, commercial 15%, final withholding tax. But if it is a revenue for the company, then that means we are dealing with a real estate, company in this case. So they are into renting out property or properties. And so the rent income is their revenue. And so in that case, it is subject to 7.5% withholding tax, but it is on account. Not final withholding tax, it's on account. So the real estate or the rental firm will still get its gross income, pay the tax or calculate the tax payable on the chargeable income, then will less the tax that was withheld by the person making payment or the people making payment in that particular case. So when it comes to rent income also, that's what we must do. Which means that if we are preparing a schedule for a company and there is rent income and they have added it, whether gross or net, we don't care. When we are doing the schedule, what do? Come and subtract it. And it won't come again under other income. It won't come again under other income. Now, the last thing that probably I could share with you on dividend, come back to dividend because something just dropped for me that I didn't mention. Dividend from a foreign entity. Now, remember all these dividend issues, can be treated as final withholding tax. So it means that if the entity has included them in their income, we'll subtract it and it won't come again. So we can treat them as final withholding tax if it is going to be subject to any tax, and that is all. It could also be treated on account, you gross it up and come in, but the final withholding tax, pretty easy in that case. But dividend from a foreign entity, okay? Dividend from a non-resident entity. So when the entity receives dividend from a non-resident entity, how do we do it? We get the gross amount and add it, so you pay whatever tax you are supposed to pay. Where the country of origin of the dividend is a country that Ghana has a double tax arrangement with, then the dividend paid in that country may be given as a tax relief in Ghana. Sounds good? So that is foreign dividend or dividend from non-resident entities that we must understand as well in that particular case. So dividend, the tax issue; interest, the tax issue; rental income, the tax issues. So those are other nuances that we need to understand in that particular case. So what does that mean? It means that the examiner could put you in a position where there is somebody who is thinking of making investment, and I think we've discussed this over and over again, right? And the person is looking at buying shares in a free zone company, in a mining and oil exploration company, or in a manufacturing company somewhere. What is the tax implication of the person or of the transaction, and advise the person which of the decision he or she should take to optimize their tax decision. You're going to be having questions like that in the exam hall, all other things being equal. There will be some questions like that. So in that case, you have to let the person understand how dividend is treated in free zones, how dividend is treated in mining and oil exploration, how dividend is treated in the case of manufacturing company, where the percentage of ownership will come in. Mining and oil exploration, irrespective of the ownership, we're going to tax you. Free zone enterprises, we don't even care about your ownership. It's going to be totally exempted from tax. So from the basis of these three, where should a person go? Free zone. I hope you are getting the idea. So that is a type of question that the examiner could pull at you, and you should be able to answer. Or the examiner will say that whatever the heck, Kukwa is having some surplus cash at her disposal, 2 million Ghana cedi, and is seeking to buy shares in a company, or make a fixed deposit at the bank, or buy some government bonds, or use the asset or use the money to buy some properties and use it for Airbnb. What is the tax implication for Kukua Limited? Beautiful question. From these three angles, that's where you got to answer it. And I know you know the answer already, so I'm not supposed to talk about it. As individual buying shares, it will depend on which company she is buying the shares in. If it's a traditional company, then based on the percentage of ownership, it may be exempted or subject to tax. If the company is a petroleum or a mining company, then irrespective of the percentage, it will be subject to tax. If the company is a free zone enterprise, then the dividend will be tax exempted. If it decides to go and make an investment in the bank, the interest on that investment is tax exempted. So Kukua, you got free money there. Okay, number 3, if you decide to now use the money to buy some properties or rent the property and sublet it, what are you doing? You are running a real estate. So the income or the revenue, the money coming in is a revenue. So it will be subject to a withholding tax of 7%. You'll be paying how much tax you are supposed to pay on the business as an individual at the end of the day. Then the tax that has been withheld from the people paying you, if they are withholding agents, will be given as a relief in that particular case. That's it. And you're going to be having nuances like that in the exam, or where the examiner just want to have, an intimate interaction with you to find out if you really understand, what the heck you've studied. So you are not going to have the question, what is the tax implication of dividend? What is the tax implication of interest? Debbie. Those are baby little girl questions. So the examiner will not go there. But it's going to put you in a place where you have to come from your soul to be able to then understand that, holy cow, this is what the examiner is asking. I catch you, then you write the answer to the exam or for the examiner. Sounds good? So that's the issue about these incomes and the way the examiner could ask you questions about them and how you can call on that to be able to write out your answers. Sounds good? Any other questions for me? Any other questions for me? I'm seeing a chat from this. It says, can you help me with the explanation of the sales price method, cost plus method? What the heck is that? I think types of transfer pricing. Okay, stay connected. We'll be talking about transfer pricing as we proceed. Who the heck is that? That is John. Also, a nice haircut. Say, thank you. Yes. Any other questions for me? Any other questions? Candy, do you have more questions or we good?
Nhyira,
Yeah.
it's not on this one. It's on. Can I still
Something
ask?
else. Yeah, go.
Nhyira, on financial cost and financial gain.
All right.
So I want to ask, in the mining and petroleum,
Yeah.
we are saying that we use the matching principle.
Good.
So if my financial cost is equal to the financial gain, does it mean I don't bring it in my workflow?
Yeah. Because we use the matching principle, the effect of financial cost and financial gain will be removed from the financial statement of the entity. So let me give you an example. So let's say that we are in the mining or petroleum, right? And let's say that they've incurred financial cost of 100,000 and they've earned financial gain of whatever the heck, let's say 80,000. Now, the financial gain would have been added in arriving at their chargeable income. So on your schedule workflow, you will subtract it. Then the financial cost would have been subtracted in arriving at their profit. So on your schedule workflow, you add it back. So you have eliminated the financial cost and financial gain rule. Then you come to the notes to your workflow. In the notes to your workflow, that is where you will explain that the treatment of financial cost and financial gain, we use the matching principle. Now, in this case, since the financial cost exceeds the financial gain, it means that the entity will write off the gain against the cost so that the excess amount of 20,000 can be carried over for the next 5 years. So number one, you have reversed what they did in the financial cost and financial gain first. Then you come to the note to come and diagnose what the heck is happening. If what is happening is this, financial cost is more than financial gain, that excess 20,000, we write that it will be carryover. So it means it won't come anywhere in your schedule again after you've done the reversal. Scenario number 2. What if after the reversal, we realize that, the finance gain was 100,000. No, let's use something else. Let's say 250,000. And then finance cost was, let's say 100,000. Stay with me here. Now, as I said, the gain was added in arriving at their profit. So what do? You subtract it in the workflow schedule. Number 2, the cost was subtracted in arriving at their profit. So what do? You add it back. Who we are, you come to your work notes. In the context of this question, the gain is more than the cost. So the excess amount of 150,000 will now be added back. So we come to other income. In our schedule, then we'll bring excess financial gain. Will be added and then tax in that regard. This is how the matching principle works. Does that make sense? Are you okay? And is there any follow-up from everybody else in respect of this discussion?
Nhyira,
Yeah?
what if, like, I'm in the exam hall and then I don't know, I forgot or something, and I bring it in my workflow. Am I wrong?
You bring what?
The financial cost and financial gain.
Like
My
you bring
question
it
is,
back
will it
into the
appear
workflow?
on the, you see, the traditional, we bring them when we are doing our workflow, we will subtract the gain at the cost.
We
Yeah,
show
that's
it
the
on the
same thing you
workings.
are doing on the mining. That's why I said on
And so we show the workings.
yeah, that's why
And my
no.
question was, will it appear on the workings? And you
Which
said no.
workings?
My workflow.
Yes, on the face of this statement of your friend is saying chargeable income flow. That's why I said you reverse whatever they've done, so it will come there. The gain will be deducted, the loss, or sorry, the cost will be added. Do you get the idea? Then you go to your notes to go and find out about the matching principle, what is happening there. Do you get it?
Okay.
So that's how the matching principle works in that case. The same thing happens to the default company, the traditional firm, where we said the financial cost allowable should be what? The financial gain plus 50% of adjusted chargeable income. So again, in your workflow, you reverse them. When you finish the reversal, go and do your workings and then calculate the financial cost that is allowable. So for traditional companies, when you finish your workings, now you will come back to your chargeable income workflow under other income. Then you will bring back the financial gain. Then you will bring in the allowable financial cost based on your calculation. So that's the difference between what is happening in the traditional companies and then the mining companies. So in the traditional companies, you reverse, go do your workings, then when you finish, come back to the workflow format, bring the gain because it must be taxed. Then the financial cost allowable is subtracted so that you can now get a chargeable income subject to tax. But for mining and petroleum companies, you reverse on the workflow, then go and deal with whatever that has to be dealt with based on the matching principle. It is only when there is gain, more gain than the cost, then that excess gain will be brought back as an addition in arriving at the chargeable income. So that's the difference there. That's the difference. Yes, yeah, your hand is up. What you got?
Yes, follow up. So if it was the case where mining or petroleum and let's say in the workflow, if you just stated in the notes because of the matching principle, this and that for mining and petroleum, and you didn't even do any adjustment in regard of the cost or gain, the statement, would you score the full mark?
So on the face of the chargeable income workings, you are not doing the
You don't
reversal.
do anything.
No,
Yeah,
you are
you don't
wrong.
do the reversal.
Because it doesn't have to be included. So whatever they've done, you have to reverse it first, then the note comes in. So that means that your workflow will be wrong, your total adjusted chargeable profit will be wrong, then your chargeable income figure too may be wrong. Because in the chargeable income workflow, unless there is more gain than the cost, then the gain only will be coming in the workflow. Do you get it?
Yeah.
Okay. All right. So that is the issue about financial cost and financial gain. A very, cardinal principle or concept that we must understand as we go into the exam more in relation to their treatment. We can have a dedicated question on that. Now remember, financial cost arises because of the cost incurred where the entity engages in transactions involving financial instruments like currency features, options, derivative financial instruments. The cost that they are incurring is the financial cost. The gain they get from that is the financial gain. This is not about interest on debt. That one thin capitalization applies. But this is the cost we are incurring on, hedging issues, currency options, another derivative financial instrument in that particular case. Because it's a theory question that the examiner can ask you, right? What is financial cost and financial gain? And you should be able to give one-liner definition for that. I think in the principles document, which I believe all of you have now, because it's available for download under the first video on the portal, the principles document, the basic principles document, I think we have this somewhere. I don't know. Let me see. Has somebody opened? Maybe you can direct me as well quickly. Let me see if I can find it. So please make sure you use, like, you leverage this principle document, okay? Because there are basic issues there that you have to be mindful of. Oh, I can't find it. Whatever the heck.
Nhyira,
Ma,
as you are looking for your document, can I ask a question?
how can I be processing that? You there, go ahead. I'm listening. I'm
I know
listening.
Nhyira, you are Nhyira now.
So look at you. Yes, I'm listening.
Nhyira, on the location incentive
Mm-hmm.
for young entrepreneurs.
Yeah.
So I know the first 5 years
Mm-hmm.
is the friend is free,
Yeah.
and then the additional next 5 years will be
Mm-hmm.
based on location incentive,
Yeah.
and then the additional
The next
5
5
years.
years, you come back to the standard
Yes,
of 25%.
yes. But Nhyira,
Mm-hmm.
still the location incentive will apply to them, just that the rate will be the one that is applicable to everybody.
Let me see if I can bring that thing up, because I don't think I would have that off head. So let's see if I can
No, I
bring that up.
mean the location incentive in their second 5 years.
Yeah.
It's lower than the location incentive that the
For
normal companies
yes,
enjoy.
yes.
So after their first location incentive, they are still subject to the normal company location incentive, right?
In the next period,
When they are
like,
in their
so
25,
so let's take it. So the first 5 years exempted. The second 5 years tax based on location. The next
yes,
5 years we will, yes, up to 25%, but still the location incentive will be applicable. Yeah, that's true.
which is the normal operations location incentive.
That's right.
Okay.
That's right. Okay, so that's it about that. I thought I would get this in the principles document. You know, sometimes when you're in a hurry looking for something, you won't find it. Then when you're not looking for the thing, then you'll find it. In the principal document, financial cost and financial gain is somewhere. I just can't find it. It's also available in the book. You know that already. I just wanted to see if I can point you out. Can point that out to you. Give me a sec. Sec. Kanish, I'm coming for you. Oh. Sec.
Nhyira,
Yeah. What? And I
is
said,
your question?
yes, I'm listening.
Yeah, I know
Yes.
you are having to answer someone's transfer pricing question
Uh-huh.
on the types,
Yeah.
but this transfer pricing question, the Percy Perry or something like that, in your book.
Page what?
It's in your book. It's in page. Mine is 335. I don't know about yours,
Okay. Uh-huh.
since you have the master budget.
335. So let me go there. Transfer pricing. Okay. Where is the question?
The question is on 335.
Percy Perry, yeah.
Yes. If
Mm-hmm.
I'm saying that they are multiplying, they're doing some
like the high of equipment. They are
Uh-huh.
doing some multiplications be on it, and
So
I
maybe
don't know where the rates are coming from.
no, maybe after the um maybe after the session, I could have you on a call and explain that to you in that particular case. But what is happening here is that a company takes a contract and then sublets that contract to their associate, right? Or their subsidiary here in Ghana. And so that is why the withholding tax is coming in, because this is services. Okay? This is services in that particular. What did they rent? Sorry. What are they renting?
They are renting technical, the
Hiring of the
technical,
equipment. Yeah.
uh-huh,
Yeah.
that rate on it, and the personal training, that
Yes.
rate on it. That's why
Yes.
I was confused.
Because you see, these are withholding taxes. The personnel cost, maybe let me see if I can run through it quickly. Then we go for you if I can do that comprehensively. The equipment was hired from the parent company, but could have been hired at this. If the parent did not provide a technical service, Perry could have done this with the same. So they are paying the parent, which is a non-resident company. And if you remember the rules on withholding tax, when you are paying individuals who are non-resident any money, the withholding tax on that is what? 25%. That is why the personal income tax, you are seeing the withholding tax of 25%. Because when you are paying somebody who is not a resident of Ghana, the withholding tax applicable is 25%, unless Ghana has a double tax arrangement with the country of origin of that person or country of residence of that person, then a lower rate may be applicable. So that is why this 25% thing is coming here. The high of the machine is also a standard rate at 20%. That is why that is also being withheld by the subsidiary on the payments that they are giving to the parent entity in that regard. So that is the rationale for these rates coming up. Do you understand? Oh, you're okay, right? So that's the idea there. As I said, maybe after the class, we could have a call, and then if there's any other further thing I have to talk about, I'll talk about. Oh, I think maybe she has lost her connection, crapple. Okay, but let me then continue with the discussion. So, financial cost, financial gain, we've looked at that. Capital allowance, please remember this is a regular cost. Sorry, let me not say regular. This is a basic concept you must understand before you get to the exam hall tomorrow, right? Capital allowance. It's like baby careful area. All right? Like as a tax student, if you don't understand capital allowance, then you are not a tax student. Then which student are you? Maybe you are doing physics or something else we have no clue about. Let me see if in the principles document I have something about this. Okay. Let's just walk through it. So when it comes to capital allowance, number one, what are the rules? Conditions under which capital allowance must be granted. The entity must incur an expenditure, so the asset must be acquired at a cost. Number two, the asset should be used in generating the income against which the capital allowance is being sought to be granted. That's the second thing, pretty important there that we must understand in that particular case. Then number three, GRA should be informed definitely on the acquisition of the asset and it being put to use by the company. So those are the conditions. Remember, goodwill. There's no capital allowance on goodwill. Why? Because goodwill is not a depreciable asset. Capital allowance is only granted on depreciable assets. So that's the issue there. Number one, key principle. Assets in pool 1 to pool 3, we say lose their identity. All right. So what does that mean? On subsequent years or in subsequent year, any acquisition that is done, we just add it to the written down value brought forward and boom, calculate our capital allowance 40, 30, 20 in that case. And then number two, these assets capital allowance will be calculated on reducing balance basis. Pool 4 and 5, we say they do not lose their identity. Okay? They do not lose their identity. And so if in subsequent years there is an acquisition of assets belonging to pool 4 or pool 5, they are put in a separate pool under the main pool. So we could have pool 4A for the existing asset, pool 4B for the new asset that has been bought during the period under review, because they do not lose their identity. Then capital allowance on pool 4 and 5 is also granted on what? Straight line basis. On a straight line basis. So that's the thing that we must understand there in that particular case. Remember, if it is the first year of business, then we calculate the capital allowance based on the number of days, not the number of months, the number of days. So that if it is a pool 2 asset, it will be the cost multiplied by the percentage. Pool 2 is what? 30%. Then multiplied by the number of days, okay, divided by 365. So if the company started the business in August, okay, on 1st August, and their year ended is 31st December, then you're going to have August, September, October, November, December. How many days do we have? August is 31, September is 30, October is 31, November is how many? 30, I guess, whatever the heck. And December is 31. So you add it up. So in the first year of operations of the business, yes, we have to calculate the capital allowance, taking into consideration the number of days. After that, anything that is coming in pool 1 to pool 3, we don't care the day we bought it. We just add it to the pool, capital allowance is calculated. But in pool 4 and pool 5, because the assets lose their identity and additions are put in separate pool under the main pool, if we buy any additional asset during the year pool 4 and 5, you can still apply the number of days rule or calculate the capital allowance for the whole year. It's also going to be acceptable in that particular case. So that is what you must understand about the application of the number of days in the calculation of the capital allowance. Then there's another important principle. If you calculate the capital allowance, and after calculating the capital allowance, the written down value brought down is less than 500 Ghana cedi, then the excess amount or the written down value brought down is given as an additional capital allowance. So you don't carry it forward to the next year. That's a key principle as well that we must understand when it comes to dealing with capital allowance. Then certainly, when it comes to disposal, any disposal that is happening, you know what we're going to do? Just subtract it from the pool, and then boom, 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 we continue calculating the capital allowance. But if the whole pool is disposed of, then the excess, if we got more money than the written down value brought forward, that excess will be subject to tax at 25%. So we'll add it to the chargeable income of the entity. But if the money we got, the realization, is less than the written down value brought forward, then certainly what is going to be happening is that the excess amount, which is the loss, is also going to be given as an allowable deduction for the company. So that is the, So that is the capital allowance. And usually, as we mentioned, this is the rule which is applicable for traditional companies. But the companies operating in the petroleum and mining sector, the dance is different. In petroleum, we have exploration, we have development, then we have production, right? And so all the costs incurred on exploration, okay, on development, and when production begins, will be put into a single pool so that capital allowance will be granted when production begins. For mining companies, reconnaissance, exploration, and mining, the cost incurred on reconnaissance, exploration, and when mining begins will be put in a single pool, and capital allowance will be granted on a straight line basis at 20% or over a 5-year period in that particular case. And then, as we mentioned, if there is any disposal by the mining company, usually we will take that proceeds and add it to their chargeable income in that particular case. But also there is that alternative treatment where the proceeds can be deducted. That treatment is also allowable. The proceeds can be deducted from the written down value brought forward of that particular pool in question or the capitalized amount in question, and then boom, we'll be able to calculate the capital allowance for the period. Please be careful, because sometimes you have to calculate or know the number of years remaining. So for instance, if the examiner tells you that, oh, there is a pool 4 asset, right? Pool 4 item, and we have the written down value brought down. Written down value brought down, or let's say brought forward, it's say maybe 48,000. You have to find out how long have they depreciated the asset, because you need to know the cost of the asset. All right? Because remember, pool 4 will be on straight line basis. Remember, that same thing will apply to the mining and petroleum. It is on a straight line basis. So you have to know the cost. So how do you determine the cost? You have to know the cost. So if, for instance, if I'm doing the mining and petroleum and they say, oh, written down value brought forward in the pool is whatever, let's say, as I said, 48,000 here. And capital allowance has been collected over 2 years. What does that mean? It means this 48,000 now must be allocated over 3 years. So what does that mean? It means if the 48 is for 3 years, how much is the whole 5 years? Because it should be allocated over 5 years. So you do cross multiplication so that you can get the original cost. Because in your working capital pool, you have to bring the cost, then you less the capital allowance calculated over the years, then you get your balance brought for written down value brought forward, then you can get the capital allowance for the current year, then you can get the written down value brought down. So that is something you have to be mindful of, where you are giving written down value brought forward for pool 4, pool 5 assets or mining companies, but you need to know the cost, because your calculation must be expressed on the cost in the schedule workflow. Please be mindful of that and that particular adjustment, because that is very important there when it comes to that area. So in petroleum and mining companies, that is the idea about the treatment of capital allowance. Now remember, this is also linked to the issue in respect of lease assets, right? So if we lease asset or lease versus buy, what is the tax implication? If you buy the asset, yes, it qualifies for capital allowance unless otherwise it's a non-commercial asset. However, we said that, and I think we had an interesting debate on this when we're discussing it. If the entity in question is engaging in construction or mining or petroleum, then those pickup 4x4 vehicles will still be what? There will be no cap on them. But if it is not such company in construction or mining, then there will be a cap on the cost at what? 75,000 when we are calculating the capital allowance. But when you sell it, there will be no cap. And that's also something you have to remember pretty well. All right? Because there is a trap that, oh, because I capped the amount and during the year they have, or subsequently the entity has sold it, then I have to also cap the proceeds. We don't cap the proceeds. All the proceeds will be brought and written off against the written down value brought forward. If it is more than the written down value brought forward, then certainly the excess will be subject to tax. We didn't ask you to buy something that didn't qualify for tax. You want to buy. So remember that very well. When you do capping, when proceeds come, no capping. All right? That is very important there, and that is what you must understand when we talk about the issue in respect of capping. So lease versus buy. When you buy the asset, as we said, capital allowance will be granted, It will be capped if we are dealing with a non-commercial asset for a traditional company that is outside construction, petroleum, and mining. But when we lease assets, that one, there is no capping issue here. The lease liability is made up of two things, or the annual lease payment is made up of two things. The capital element is given as capital allowance, and then the interest element is given as an allowable deduction. As I keep on telling you, don't just go there and write that, for the annual lease payment, it's allowable for tax purposes. No, that's too shallow. So you have to categorize it that the capital element of the lease payment is granted as capital allowance, and then the interest or finance element of the lease payment is treated as an allowable deduction. That's what the examiner wants to hear. And because that is the rule about leases. So if you are lazy and just go and write, the annual lease payment is deductible for tax purposes. If the whole max is 3 marks, maybe you get 0.5 or you get 0. but you know what you say is true, right? Because it's all deductible for tax purposes, but you don't say it like that. You have to give a breakdown. You are a tax expert. All right? That's why. In a simulation in the exam hall. But that's the idea about a lease or buy that we need to understand as well in that particular case. Okay? Then on crystallizing on the petroleum situation, if you remember I said, make sure you read on the sources of revenue to the government. Remember we discussed these things, right? The revenue. Please make sure you read them. I don't know, maybe tomorrow as you go to the exam, or the examiner could get some goosebumps. But remember also, it's not just about reading them, it's about the calculations we did about them. Remember that. So either we will have the written aspects or those calculation questions we solve. Your friend is saying, Brima, energy, Enasa, nyoma nyoma, those two questions we solve. You remember that? Please review that. Because the examiner can come there as well for you under the petroleum and mining situation. Then the types of revenue that government gets from the natural resources, okay, mining and oil exploration, income tax, 35%, carried interest, we said is free equity. Government holds free equity in all mineral operations and has no financial contribution for it. It's free equity for mineral operations. Then we have initial carried participating interest. This is where government catches the train, because government has the right through the GMPC to acquire about between 7.5% and 15% in all commercial discoveries. But here, government catches the train after the development. So government will make contribution to production. Then we come to additional carried interest. This is where the government catches the train a little bit earlier after the exploration. So immediately after exploration, the contractor is starting with development. Government comes in with additional carried interest. So with the additional carried participating interest, government makes payment for both production and then what? Development. And government can take up to 5% in every commercial discovery as the additional carried or participating interest. You get the idea? Please, the percentages are important too. The percentages are important because you're not just going to be writing this, oh, initial carried interest is where government through the GMPC gets an interest in every debi, and government contributes only to production. Yeah, it's good, but it could be better. It could be better where you say that, all right, under the Exploration and Production Act, if you can't quote 2016 Act 919, just be generic. Under the Exploration and Production Act, the government of Ghana has the right to acquire between 7.5% to 15% in all, discoveries. That's a swag. All right, that's the quality of answer you are supposed to write at this level. Janie, baby, careful answers. So get that very well. Then additional oil entitlement. We said, hey, this is additional benefit that the government gets when the operations exceeds what the contractor had originally stated. And we solved a question about this as well. And you saw it, how it was dealt with generally. So make sure you understand that very well. So like I simplified this illustration to tell you that, hey, the contractor says, hey, I'm going to be producing 1 million barrels per day. Then they start production and they are now producing 1.5 million barrels per day. Ho, ho, ho. It means the deposit was more than, you thought, and the capacity could do more than you had told us earlier. So that extra oil, government has a share in it. Now, the sharing rate, that one is agreed in the petroleum agreement with the party when the contract is being signed. Remember, the portion of that excess oil that the contractor will get will be subject to tax. So please be mindful of that as well. Then certainly profit oil, surface rental. Sometimes the examiner could be easy on you and he lists some of them and asks you to write on them. Other times he wants to get you excited. So we just say the government of Ghana makes a lot of money from the extraction and petroleum subsector to finance its budget and other infrastructure projects required. Explain 10 of these revenues. Or 5 of the revenue. Okay, 10 is too much, but 5 is reasonable, right? Or just generically explain some of the revenues. And so that's where you're going to be coming in from these areas in that particular case. Sounds good? So please know the definitions of the items here. Then the calculation question we did in class, please make sure you go over them. Okay, about how carried interest and the way we allocated the cost, and where there was the petroleum thing, the way we share the oil, the sole rigs, additional oil entitlement before we share. So that's 2 questions. Make sure you go through them before you get excited into the exam hall tomorrow, because we could have this theory, or we could have that calculation, or we could have standardized question from the petroleum or mining. And still remember, in the petroleum and mining, we have financial cost and financial gain coming up here in that particular case. And so the full questions on petroleum and mining, you remember the various terminologies, right? Stoop development and its associate. I believe you've done some research to familiarize yourself a little bit about some of the terminologies, because if you get to the exam hall and something is supposed to be a capital expenditure, and because of your ignorance, right, about that item, you don't treat it, you don't bring it, au revoir, mon ami. You just screwed up and you got some of the part wrong at the end of the day. So you want to be mindful of that. Then those other terminologies that we spoke about, please make sure you read them. Tax holidays, tax planning, tax rebate, okay, Those terminologies under the standard tax planning measures, make sure you read them. Okay? Very important. Very, very important area. Then the issue about transfer pricing. I think we discussed this as the final part of our discussion. Is the material in the petroleum and mining document, or is in our main question kit? I think it's in the main question kit, yeah. So transfer pricing. Remember we said transaction between related parties or among related parties should be taken at what? Arm's length. And the arm's length transaction simply means that transaction between related parties should be on the same terms as unrelated parties. So if you remember in class, we discussed something and I said that, oh, what if we have Kantanka automobile? Okay, let's say Kantanka Onante for, I don't know some of the brands of the car, but whatever. Kantanka Onante for or Obrimpon, I think they have a car like that. Kantanka Obrimpon. Then they sold Kantanka Obrimpon to Kantanka TV. Then TV3 also buys that same car. Then Kantanka TV, they sold the same car to Kantanka TV for, let's say, 400,000 Ghana cedi. And they sold the car to TV3, same Kantanka Obrimpon, for, say, 700,000 Ghana cedi. Why? What's going on here? And so remember I said there is a question where the examiner may ask you to advise the GRA, the Commissioner General, what he should consider before approaching Kantanka automobile on the possible transfer pricing issues. And what are some of the things we said? Maybe the terms of the acquisition. Maybe Kantanka TV is buying and paying cash. TV3 is going to pay on credit over 5 years. That is why it is expensive. Maybe it's because of marketing campaign. Kantanka TV bought it when it was launched and they adopted the penetration pricing, so lowest price at the introductory stage, but after some time the price will be increased. And when the price was increased to the actual fair value, that was where TV3 came in to come and buy. So that could be another reason. Number 3, the specifications of the product. Maybe Kantanka TV bought the base model of Kantanka Obrimpon, but TV3 bought the advanced model of Kantanka Obrimpon with some other features, right? Like when you are coming back, it says Kowechio Frimechi Nameba, Namebo Meba, or maybe the tie, all right, or maybe the engine capacity and all those things. So the specification could also be a reason why this is happening in that particular case. And then certainly the cost of production. Okay, so maybe based on the specification that the fact that this Kantanka TV bought the base model, the cost of production was lower. And so when we added our markup, standard markup, it's landed at 400,000. But TV3, because they are buying the advanced model, or they bought the advanced model, when we got the total production cost and added our markup, it came to the 700,000. And so although Kantanka Automobile and then the Kantanka TV are related parties, that may not mean that the sales was not done at arm's length. And Nuntina, GRA must consider all those factors and find out if there is something like that. So that if it is true that TV3 is buying the asset and going to pay over a period of time, they are financing it. Kantanka TV is paying cash, then it makes sense to say that, okay, that may be why they are buying differently, they are buying it at different prices. Or better still, if the specification, Kantanka TV is buying the basic model, as I said, TV3 is buying the advanced model, then that's it. So GRA then doesn't have to worry themselves and go and say, oh, this transaction was not taken at arm's length. So that is the arm's length principle and a question about it that the examiner can access. And it is also connected to the concept of transfer pricing at the end of the day. Remember, as part of standard tax planning measures, where the entity or when the transfer pricing principle is done and it is not at arm's length, the GRA has a right to what? Reverse it. We discussed these about the limitations of standard tax planning, right? If you remember, the maxims or variables of tax planning, we spoke about what? The location, right? Or jurisdiction, the same thing, location. Then the entity variable, okay? Individuals pay tax at a different rate. Companies pay tax at a different rate, and the type of organization also influence the tax that the company or the organization will pay, right? Then we came to what are the other variables? Location, entity, time horizon. That tax that is paid now is expensive than paid in the future. So time horizon variable. And what's the fourth one? What's the fourth one?
Activity.
Activity, yep. Activity. So you are going to be taxed based on the activity that you are into. So companies that are in the manufacturing space are taxed differently from a company that is going into tree crop or cash crop production or whatever the heck. So those are the maxims or variables of standard tax planning. We discussed these. Then the limitations, we spoke about what? The juridical, let's start with the first one. The legislative constraint, which says that, yes, in the same tax law that permits the taxpayer to, write off certain things against tax, there are also caps in that same tax law that prevents the tax authority. One example is the thin capitalization issue that we spoke about. That, hey, listen, all interest is tax deductible. Go borrow money from a non-resident entity. Go borrow money from a resident entity that is a controlling interest. Then that rule is gone, right? Then income splitting. An entity may decide that, it is splitting income so that it will charge majority of the income to a part of the entity in a lower tax bracket. Yeah, you can do income splitting. You are planning your tax very well. But if tax authority steps in and realize that, what you did, it's not right, then you're going to be in trouble. And like I use this example almost always, say we have a company in Accra, then we have the other company in Nsawam. Then and they are all subsidiary of the parent entity. And they got they got a project and they execute the project together, got a profit of $100,000. Now, the manufacturing company in Nsawam is going to be paying a tax of 12.5%. The company in Accra or Tema is going to be paying a tax of what? 25%. And so, for income splitting purposes, they said, the company in Nsawam, they did 90% of the job. So they charge $90,000 and charge only $10,000 here. That's income splitting. It's a way you plan your tax. It's acceptable. Until GRA steps in and say, what the heck is going on here? You mean to tell us that a company in Nsawam did 90% of the job? Where is the evidence for that? If you cannot produce the evidence, then you lied. But income splitting, it's a way to plan your tax, isn't it? But you are doing it illegally. The reason you are charging 90%, we believe, that the reason you are charging 90% revenue to the Nsawam subsidiary is because that one is in a lower tax bracket. And you are charging only $10,000 to the Accra and Tema, it's because that one is in a higher tax bracket. So you are not doing the income splitting on the commercial level, on the economic grounds. You are doing it to evade tax. That's the idea. So although income splitting is a tool that can be used to plan the tax of the company, if it is not done well, the law says GRA can step in and rewrite the transaction. So there has to be documents supporting whatever the heck has happened. Then GRA cannot say anything. But if there is no reasonable supporting document, remember, so that hey, the reason you are doing this is because the company is on pays lower tax. And these days that GRA is very hungry. When they catch you like this, they will reverse the transaction and then, slap you with some penalties for evading and lying to the GRA. So that's the issue about income splitting, and that is the legislative constraint. So I spoke about thin capitalization. I spoke about income splitting, right? And then the concept of transfer pricing is also there, where the transaction can be reversed. So that is legislative constraint in the law, the same law that permits people to leverage, that has loopholes that you can leverage. In that same law, there are some constraints within which that places a cap on you to maximize the loopholes in the tax laws. Such an interesting thing. Then the second one is the legislative constraint, right? Which is where, did I say legislative? Sorry. Judicial constraint, which is where, based on case issues in the previous year, the tax authority can rewrite what? Certain transactions at the end of the day. Then certainly we spoke about uncertainty. Yeah, because no matter how fast or quick you think you are, you could be screwed up. So maybe you thought that you're going to avoid tax now and pay the tax in future. Guess what? There's a new government in town. They have increased the tax rate. Then you're going to be in trouble. So that is the uncertainty that comes by in that regard. Or you decide to defer a certain income, not to recognize the income now, but defer it into the future, because you feel when you defer the income into the future and recognize it in the future, you pay lower taxes. Here you are. That is not the case now. So that is also something we must understand under the standard tax planning measures and then the limitations. The reason I came back there, because of the transfer pricing issue that is under the standard tax planning measures. But the types of transfer pricing, if you remember, we said, according to the Organization for Economic Cooperation, that is OECD, there are types of transfer pricing that we need to understand in that particular case. Okay? Types of transfer pricing that we must understand. So please make sure you read these and we discuss them with some examples. Cap method. This is where we look at a price between a controlled and uncontrolled transaction and determine whether really there is a transfer price. So here we said a company sells a product to an unrelated company for $100. The same product sold to a related party, price is compared. So that if it is the same $100, then there is no transfer pricing issue here. Because you are selling the things at $100 to unrelated companies. Then your associate or your partner or your subsidiary, you sold it to them also at 100. Then there is no problem there in that particular case under the cap method. So prices are compared between control and uncontrolled transactions in a comparable circumstance. So the circumstance should be the same. That is what the example I gave here about the car issue between TV3 and Kantanka TV. Right? So if the car was sold to them at the same price, then that's not an issue in that particular case. But if it is the same car, the same model, sold at different price, that means the transfer price that the parent is using for the Kantanka TV is different, and GRA can step in and rewrite that particular transaction. Number 2 is the issue about the resale price method. We said that this refers to the price a product that has been purchased from a related party is sold to an independent, unrelated party. That is the resale price method. So again, an example is here. A distributor purchases goods from a related manufacturer for 150 and resell them to an independent customer for 200. The resale margin is calculated, and we look at it and find out whether it's a reasonable amount. That's the resale price. So was it sold to you cheaply so that you sell it for a high price, and because you are in a lower tax bracket, you will pay less tax? Or it was sold to you at the price at which it was supposed to be sold, so that when you also sell it, you are selling it at a normal margin. That is a resale method. Then cost plus, no problemo. We just add a standard margin to the cost of production. So if the cost of production, and we apply the standard margin, and it is the same thing for everybody, then that is a cost plus method. There is no non-arm's length issue here. GRA cannot step in to try to rewrite any transaction at the end of the day. Then the transactional net margin method, okay? The transactional net margin method in that particular case. Nhyira, these explanations are simpler than the ones in the book. Look at this lazy girl. Look at this lazy girl. Lazy girl. You like simple things. Yeah, that is why we included it here for you. It's the same thing in the book, just that in a comprehensive manner. Right? You're just lazy. You don't want to read plenty. So that's why we included this in the question kit for you, so that you go with a simple approach rather. Okay? So that will be more understandable. So you there stay with a simple one, since you like that one. Shame, shame, shame on you, lazy girl. Then the transactional net profit margin, we said that here, the net profit is calculated from a controlled transaction and compared to the net profit from an uncontrolled transaction. And we expect that the net profit should be what? The same. Then there's no problem there. Then the profit split method. This is the sample of what I did here on the $100,000 issue. The profit split method. So on what basis are you sharing the profit? We expect that the profit is being shared based on the cost that each of the entity incurred or the resources they consumed in executing the project. Once they are sharing the thing based on the cost they have incurred or the resources consumed they used in the production, then that there is no problem in there. But if the GRA smells that you are splitting this thing and doing this agenda because the entity in the lower tax bracket is getting higher amount because you want to avoid taxes, here you are not avoiding, you are evading taxes, then GRA will rewrite the transaction in that particular case. And that is the issue about the types of transfer pricing as well that we need to understand and know about in that particular case. So John, I don't know if you are still on the stream on YouTube. I think you were asking about these things. So what the heck? Sorry. So you were asking about these things. Those are some of the things that you must understand there. Okay. Any other issue? Finally, probably, there are other issues, but gonna wrap up here. I don't know.
Sure.
Fiscal policy,
If
you want to
not
make
talk
sure.
about VAT, if not talk about VAT, if not talk about capital gains,
Hey,
hey,
you want me to talk
that's
about
also.
all of these things? You want me to talk about all of these things? And then point. So if we come to chargeable gains, this is also another area that we need to understand. If you have my book, page 159 of the book, the issue is there. The idea here is pretty simple. It's divided into two. One, gift tax. So how do we deal with gift from employment? We add it to the chargeable income of the individual in question. How about gift from businesses? So if businesses receive gift, what do? It will be included in the chargeable income of the business. Okay? Gifts from investment, the same idea, included in the chargeable income at the end of the day in that particular case. Now, all gifts received will be subject to tax at a rate of 25%, except gift from close relatives. What do we mean by close relatives? Spouse. That means wife, husband, sister, brother, nephew, nieces. Asa. That's what we mean by close relative.
Uncles and aunts account.
Okay, say nephew, nieces, uncles, and auntie. Okay, the same idea in that regard. Thank you for that. So, brother and sister, I didn't even bring that up, right? So, brother and sister, husband, wife, nurses, nephew and nieces, and then auntie and uncle. That's close relative. Any gift outside of that is subject to the 15% tax. 20%, 25%, Nhyira, take it easy. 25% tax. Previously it was 15, now it's 25%. 25%. So as I say always, from gift tax alone, we can build this country. From gift tax alone. You're having a wedding ceremony or something like that. All the gifts from the other people, apart from these close relatives we mentioned, should be subject to withholding tax of 25%. Imagine GRA going around every Saturday and every Friday. The money we can get in this country. Birthday parties. But that's gift tax. So apart from those close relatives, that the gift will be exempted, any other gift at all, under whatever circumstance, is going to be subject to tax at 25%. That's the concept of gift tax. There is no much thing about that in that case. As I said, if you're an employee and you receive gift, we include it in your chargeable income. The business receives gift, we include it in the chargeable income because it becomes an income which is going to be subject to tax in that particular case. Then the second part of the discussion is the issue about capital gains tax. Please remember these things, returns and payments, okay? The rule about gift tax is that within 21 days of receiving the gift, you have to submit returns to the GRA. Within 21 days of receiving the gift. How many of you have filed for gift tax before? Nobody. It's like you've never received gift. You people, you can lie, Papa. But the returns, and the returns must have...
They themselves, they are sinners.
What have they done to you?
But they also receive, they don't declare.
Have you seen any GRA worker tax returns before? So the tax return should include the following: the description of the gift, where it is located, maybe it's a permanent gift or something like that, the value, how the value was calculated and the tax payable, the full name of the donor of the gift. But you know, when we get to the place where we are digitized, don't worry. Don't worry. Some of these things you will see them already. Because for instance, once you receive some Momo, we have to find out what kind of Momo did you receive, man? Was it Momo for a work you've done? Okay, Momo for your salary, or Momo for a gift for your birthday. So that we can tear our 25% before you start negotiating. And that's called, when we get to that level, GRA will withhold all those taxes. So at the end of the year, you have to file your own tax returns so that you can now let GRA understand, oh, by the way, this money was for this, this money was for this, this money was for this, because you better remove that answer na sikana hate your account. And that is the extreme, utopia level that IT can get us to sometime in the future. The second thing is capital gain tax. Okay, we buy assets and we sell the asset. The gain on the asset is also subject to tax at 25% in that particular case. Now, so remember the cost base of assets, right? The cost base of assets shall be the construction cost that you incur. If we fence the property, maybe it's a land, it will be there. Maybe we call a valuer to come and value the asset. It's part of the cost base. Maybe we have to advertise. It's part of the cost base in that particular case, in all those areas. Remember, if there was a development on the land or on the asset, but as at the date of the disposal, that development is not there, the cost of that development will not be included in the cost base of the asset. What do I mean? So we buy a land and then we fence it. We incur a cost of 30,000 Ghana cedis to fence it. But land guards came and demolished all the fence. When you are selling that land, the cost of fencing, 30,000, cannot be included in the cost base of the asset because that's kanashi. Why? Because the fence is not there. Go to the land guards, they will give you the money. So any development that is not there at the date of disposal of the asset is going to be not included in the cost base of the asset in that particular case. And that is what you need to understand in there for that. Okay? But there is an exception, which is called a rollover relief concept. You know, although it is subject to the withholding tax, the tax rate at 25%, the entity or an individual can avoid that tax, and that is where the rollover relief comes in. So if in the same year of assessment, the money, the proceeds from the realization is used, all of it or part of it is used, then you will get a relief on that portion that is used, and you will not pay the capital gain tax, meaning you are carrying it into the future because it's unrealized. Yeah, you sold the property, but you didn't chop the money in your mouth. Right? You didn't chop the money in your mouth. You used the money for something else. And so the the tax payable is going to be forward into the future. And as I say always, this is how wealth is built by the wealthy people. So they are amassing wealth, building, having houses, having properties, but they are paying zero in capital gain tax and all those things. Yeah, because they didn't sell the property and go and chop the money. They sold the property, added money to it, and bought another property or something like that. And the wealth keep on expanding as they go in that case. So those are the things that we must understand also about the capital gain tax. And then certainly there are some practice questions in the book. You can go through them and then have some ideas about them in that particular case on the gift tax and then the capital gain tax situation. Okay? On the gift tax and capital gain tax. Then the last issue, probably, then we can go because, I got to leave you guys. The VAT. Minimum of 10 mark question is waiting for you in the exam hall, but actually that place is 15 marks. Because this is taxation of transactions. I think that's the name in the syllabus or something like that. 15%. And so VAT, there is a lot of material here. A lot of material here. What do you have to look out for? First, remember the types of, supply. Taxable supply, relief supply, exempt supply, mixed supply. Know them. Number 2, registration for VAT withholding. Registration for VAT. Right? We have the statutory or obligatory registration. Then we have the optional registration. Got to be mindful of that. What are the benefits of registering for VAT? Okay, what are the circumstances under which the name of a VAT withholding agent will be expunged from or removed from the VAT register by the Commissioner General? Okay, we spoke about that. When the person no longer have a permanent home, when the GRA determines that the person is no longer keeping proper books of account, when the person's, sales is below the threshold, right, then we can remove the person's name from the list. Remember, the GRA can also reject application to be registered as a VAT agent if the person or GRA is of the view that the person has no permanent abode or place of business. Number 2, if the GRA cannot conclude that this person will keep proper books of accounts and also file proper tax returns in that case, or if the person is engaged in exempt supply, okay, because exempt supply means the supply is not subject to tax in that particular case, and so if you're engaged in that, why the heck do you want to register for VAT? So you want to be mindful of those theories as well. Then the penalties and the fines. Okay, the penalties and the fines. Be mindful of that. Then you come to the calculation aspect. The calculation aspect of VAT. We don't know in that 15 marks, definitely there will be some calculation areas. Because it's 15 marks. In as much as there's a lot of theory there that the examiner could visit us from, there are also calculations there that we need to understand when it comes to the value added tax as well. So remember the calculation we did in class, that sample calculation could be there, or other forms of calculations under the VAT. Give me a moment, let me see if I can show you this. I don't know if I have it in the book. I should have it in the book. Please hold on, I'm coming. Sorry, give me a sec. Not that I'm coming, like I'm coming to you. My brain. Yeah, that cover vignon, the question 5. That one we solved it in class. Okay, so it's not here. So there is another calculation style of question. I thought it was in the book, but it's not there. It's a type of question where you'll be required to calculate the oh, why is this still not coming? Oh, you'll be required to calculate the value of, there is something, I don't know, I forgot. I don't think I can remember this. I think the written one is what we have in the book. Determination of the value of imported goods, customs. I don't know if you remember. Please make sure you go over the flat rate system and then the standard rate, how it applies. Remember, the people applying the flat rate system, they can't get the input VAT relief. It is only the people doing the standard that will get the input VAT relief, right? So please make sure you read the difference between these two, because the examiner can throw us a question. If you remember, we discussed something about determination of the value of taxable import goods. Where is that thing? It's in the book. Like, we discussed this. I just have forgotten where the heck the slide is.
It says you come back to the doors to me.
Ah, la la la. Yeah. This one. For custom purposes, the value of imported goods shall be the transaction value. That is, the price paid or payable for the goods when sold in the country of origin for export into Ghana. Okay? For export into Ghana. So the value of importation. The reason why that is important is that the value of the import, we will then have to do our various calculation of VAT, of your friend is saying, get fund, NHIL, and all of the other useless taxes that are available there in that particular case. So the determination of the value of import, very, very important. So we didn't solve any question about this, but please remember the elements, so that in case the examiner brings the question up, you know what is supposed to be there. It's like IAS 16, the determination of the initial cost of the asset, purchase cost plus all other directly attributable costs incurred in bringing the asset to its present use. Here also, these are the things. So it will include the cost of the container, cost of the package packaging, whether labor or material, royalties or fees, loading, unloading, handling, all these will be included in the determination of the value of imported goods. Because when we know the value, then we can do the various calculation about how much VAT has to be charged, how much NHIL, how much get fund has to be charged, and the various other import duties that will be charged in that particular case. So when it comes to the calculation of VAT also, aside the style of question that we solved in class, the ACOVA Vignon workflow, we could also have this style of question coming in. Or number 3, the standard VAT issue, which is this pro forma. And that's too easy though, but the standard VAT pro forma in that particular case. So you make sure that you know about that, because definitely there is a 90% probability that there will be a calculation on the VAT. Upeo, 90% probability. So that's the idea there. Finally, the concept of double taxation. Okay, please remember to read that. Okay, what are the benefits of double taxation? Which countries Ghana has double tax arrangement with? As I say always, just imagine the countries you will go to if you have money, and at least you are going to be right. So the countries Ghana has double taxation arrangement with. Remember Nigeria. Okay, remember
Singapore, but
UK.
it's not there.
Remember Ghana has a double tax arrangement with Singapore.
I didn't see it in your book.
But Ghana has a double tax arrangement with Singapore. So Singapore is there. You can add it in that particular case. Then the methods that are used. Companies use relinquish. So if he says, the entity has elect to relinquish, it means the tax paid in that foreign country will be given as what? An allowable deduction. Before we get the chargeable income, then we calculate the tax of the company. But we can also use the effective rate concept for individuals, where we compare the effective rate in the foreign country to the effective rate in Ghana. We use the lower of the two on the gross foreign income to calculate the tax relief. That's all I want you to understand. The lower of the two effective rates on the gross foreign income to get the tax credit relief. But remember, when you're calculating the effective rate in Ghana, the gross foreign income will be included in determining the total chargeable income of the individual. So please, double taxation, very crucial. What is it? What are the benefits? What are the limitations? Which countries does Ghana have double tax arrangement with? Then the calculation part, right? Then the calculation part. Then certainly what the GRA does when they receive a claim for double tax relief. Okay, so first, is the person a resident of Ghana? Because again, you got to be a resident. Secondly, does Ghana have a double tax arrangement with the country of origin? Third, did you really pay tax, or is the income does the income have a special treatment? Because remember, we have the exempt method where the income is not even taxed in that country, or it is taxed at a reduced rate. That means we'll benefit no wajidada. The whole income will be included in the tax in your chargeable income and taxed here in Ghana. So when it comes to double tax arrangement also, these are some of the things that we have to be mindful of. Again, it's a crucial area, and if you check, there's a lot of things in taxation. A lot. Fiscal policy, please don't forget, there's a question waiting for you on that. It's in your syllabus. Okay, so fiscal policy, we discussed this in session session 1. That's where we discussed it. So fiscal policy, make sure you read it, because there's a question on that waiting for you. 10 marks. 10 marks question on fiscal policy is waiting for you. We discussed this in session 2. So you can go to session 2. I think either session 1 or session 2, one of them. I don't know. You can check whatever the heck. We don't have, this is not available in the summary videos. It'll, I think I'm told from next semester in that regard. That's when they can make this available under the summary video. For now, you are on your own. Yeah, fiscal policy in session 1. So you can watch that video on the fiscal policy because I gave a summary form of it, so you don't have to watch or come and read the whole thing. Because if you look at the reading from page 49 to 75, if I were, but you could spend, I think, I don't know, less than 15 minutes on the discussion that I did in the summary form. That will help you to go to the exam hall and write something. Then certainly taxation of individuals and partnership, you want to make sure you go through that as well. That's all about that. I'm going to wrap up around here today so that I will leave you guys to go and relax and sleep. Get up tomorrow morning and go to the exam hall and do what the heck you have to do and pass the examination. All right. So I will wrap up here today in that particular case. But before the exam tomorrow, certainly if there is anything, you can reach out and then you will be assisted in that case. Okay? So please. We've already spoken about this, but let me just quickly highlight it, then we go. Be mindful of the fact that we're going to have a mixture of calculation and written questions. So take time to read through all the questions. Taxation, you can get it wrong very easily. You can spend time to write 1.5-page solution and it is wrong. The context of the question. So I beg you, in the name of God, when you get there, read all the questions, take your time to make sure you understand the context, especially of the written questions, so you don't digress. Because you can digress very, very easily if you don't get the context of the question. That's the first thing I want you to take away. Number 2 is the structure of the way you write out your answers. Professional presentation is key here, right? So if the examiner asks us anything about what is the tax implication of something, or we should advise somebody on an investment that the person is going to make, or something like that, you have to know how to write it up. Introduction, tax issue, tax implication, conclusion, thank you. Pro forma. If you can't quote the act, as per the Income Tax Act, it's okay. Go away. As per the tax provision, as some of you do. But hey, be professional at least. Income Tax Act 2015 Act 896 as amended. We're heading. You don't know. Sometimes in the exam, your brain can freeze. It's true. Sometimes you can't even spell that. You are sitting there. The tax authority, then you're like, what is there? You can spell the authority, but you can't spell the. And like you could have that, right? You just calm down and then, it will come naturally. You just calm down, it will come. So the structure of your write-up, very important. Please work on your time. Speed and accuracy is key. Don't get too much excited. Some of you know what I mean by not getting too much excited, meaning you write more than you are supposed to write. Again, stay within the ambit of the question. Remember the difference between trading in Ghana and trading with Ghana. Remember the difference between the tax implication of trading in Ghana and trading with Ghana. Then certainly what businesses are reserved for only Ghanaians that foreigners cannot undertake. That's also something I want you to be mindful of as you go into the exam hall. All right. So read the questions well. Presentation of the question, very important. Move with speed and accuracy, very important. For all the format issue, if you are preparing calculating the chargeable income and the tax rate of the entity, as I told you, go to the notes and write at least 3 or 4 notes on why you added certain things, subtracted certain things. Please don't ignore it. Because the note is explaining to the examiner why you did certain things that you did. So don't just add and add, subtract and walk away. No, at least write notes on 3 of the things or 4 of the things. That is very important there. So if you can do these, I believe that by the grace of God, you should be able to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. Yes, there are a lot of things going on here, but we are going to be having questions from almost all of the areas. Almost all of them. Almost all of them. There will be questions on VAT. There will be questions on fiscal policy. There will be questions on companies. We didn't even talk about changes in ownership, but you know the rules about changes in ownership. Make sure you remember those things as well. Mining and petroleum. There will be question about mining and petroleum. We know because it's in your syllabus. So yes, there is a lot, but as I say always, if you've been studying from session 1 up to this time, you're just going to be cruising in that case. So again, you can leverage the summary videos in the mobile application to make some of the principles very easy for you. Because as I say always, 99.99% of the time, the questions you're going to see tomorrow, you've never seen them before. So you're just applying principles based on the things you understand. So in as much as it is good to be solving questions, you have to also familiarize yourself with the fundamental principles. Once you know your principles, if you see the question, you can do it. But if you don't remember the principle, then you can solve 7 million questions and you will still have problems at the end of the day. All right? So that's it about that. And we will end here. And we wish you all the best as you go in there. As I said, if there are any things before tomorrow 2 p.m., you can hit me up and I'll be glad to assist you about it. Okay? So all the best, and we will see those of you who are graduating at graduation. Those of you who are continuing with the other papers also. We'll see you in other papers other than this one, right? That you're yet to write. So that's it. Good night. All the best, and we'll see you some other time. Bye-bye.